The International Monetary Fund sharply lowered its Middle East and North Africa economic forecast to its lowest level in last 50 years over the twin shock of the coronavirus pandemic and low oil prices. The region's economy will contract by 5.7% this year and shrink by as much as 13% in countries torn by conflict. The Washington-based International Monetary Fund updated its latest report on July 13, 2020. The economic malaise will see poverty and unemployment rise, shocking social unrest, and send budget deficit and public debt surging. In its regional economic outlook update, the fund projected the economies of the Middle East and North Africa to contract by 5.7% this year, 2.4% points lower than fund's April forecast. The projection is the lowest in over 50 years, according to World Bank data, and comes after the region posted modest growth last year. The battered energy-based economies of the Gulf Cooperation Council, that is GCC, the states are forecast to shrink by a hefty 7.1%, 4.4% points lower than April forecast. The region has been facing a crisis like no other, a twin shock that affected the normal functions of their economies during the confinement measures. The Middle East countries applied some of the most stringent lockdowns and measures against the coronavirus, halting most economic activities. Oil prices plunged by about two-thirds in a free fall, and as the global economy ground down to prevent the spread of coronavirus, they have partially recovered to around $40 for a barrel. The region's oil exporting countries are expected to lose around $270 billion of energy revenues, which is a big drop off this year. The region's hardest hit countries will be those that are fragile and in conflict situations, with their economies forecast to contract by as much as 13%. GDP per capita in those unstable countries expected to plummet from $2,900 in 2018 to 2019 to just $2,000 this year. This is a dramatic downturn that will aggravate existing economic and humanitarian challenges and raise to a high poverty levels. Social unrest could be rekindled as lockdown measures are lifted. Job losses, together with worsening poverty and inequality, could create stability challenges for governments in the region. Job losses will come on top of an already high level of unemployment, especially in youth age bracket. Large and growing deficits are expected to push public debt levels to 95% of GDP among Middle East oil importers by the end of this year. Debt levels are forecast to grow rapidly in Sudan to 58% of GDP, Lebanon to 183% and Egypt over 90%. The woes of oil importing nations are also compounded by a sharp drop in remittance from their nationals working overseas, who have been put out of work due to the pandemic. The potential decline in expatriate workers, who account for more than 70% of the labor force in some oil exporting countries, would also dampen their recovery. Some 25 million expatriate work and live in the 6 GCC states, forming half of the population of the group, which takes in regional powerhouse Saudi Arabia and United Arab Emirates, along with Bahrain, Kuwait, Oman and Qatar. Oxford Economics predicted in May that employment across the GCC could fall by 13% this year, with job losses of some 1.7 million in Saudi Arabia and 900,000 in UAE. In the current environment, the situation could be even worse than forecast. Uncertainty about the capacity to control the pandemic and its expansion. Uncertainty about the recovery itself and also uncertainty about the oil prices. The historic oil price crash and COVID-19 pandemic have left major producers of the commodity in deep economic crisis. Domestic production cut by OPEC has exacerbated in situation by further lowering export flows for economies that depend heavy on oil dollars. Some, such as the UAE, have tried to put on a brave face by touting the strength of their banking system and claiming they can withstand shocks of any scale. Unfortunately, the growing body of evidence suggests that pretty much the opposite. The wave of banking mergers is sweeping through the Middle East as the sector scrambles to stay afloat amid slowing economic growth. About 450 billion US dollars worth of deals are already on the table. That's a remarkable feat for the region that has the lowest banking penetration anywhere on the globe. Interestingly, Saudi Arabia, guilty of initiating the oil price war with Russia that triggered the oil price crash, is well represented in the growing trend. The first one on this list is Saudi Arabia. Saudi Arabia is the National Commercial Bank, Saudi Arabia's largest lender by assets, has lined up a 15.6 billion US dollar takeover bid for rival Samba Financial Group. The 15.6 billion US dollars tab represents a nearly 30% premium to Samba valuation before the deal was announced, while the potential deal will create a 210 billion US dollars asset behemoth. The Saudi Arabian Monetary Authority, the kingdom's central bank, has unveiled nearly 27 billion US dollars in stimulus packages to support its flagging banking system, suffering from years of weak private sector loan growth. The kingdom's oil and gas sector accounts for 50% of GDP and 70% of export earnings. The IMF has estimated Saudi Arabia's fiscal break-even sits at 76.1 US dollars per barrel, a far cry from the current 40 US dollars per barrel. The Public Investment Fund, PIF, Saudi Arabia's sovereign wealth fund, is looking to complete other such mergers to make the sector more competitive. PIF is National Commercial Bank, that is NCB, and Samba's largest shareholder with a 44% and 22% slice of NCB and Samba respectively. In June, Qatar's Masraf Al Rayyan QSE and Al Khalij Commercial Bank PQSE kicked off an initial negotiation to merge their operations. The potential merger could create a combined entity with more than 45 billion US dollars in asset, as well as one of the largest Sharia compliant banks in the region. The deal flaws the 2018 tie-up between the country's Barwa Bank and International Bank of Qatar that saw the proposed three-way merger with Mashraf Al Rayyan abandoned. Qatar is the world's 17th largest producer of oil, pumping 1.5 million barrels to the commodity per day. The country's economy is heavily reliant on oil, with petroleum and natural gas accounting for more than 60% of the GDP, 85% of the export earning, and roughly 70% of total government revenue. Nevertheless, the IMF has tapped Qatar as one of only 7 countries expected to run a budget surplus in the current fiscal year thanks to heavily scaling back capital spending. The third one in this list is UAE. In January, Dubai Islamic Bank, United Arab Emirates' biggest Islamic lender, completed a deal to buy smaller rival Noor Bank in an all-share deal. The combined entity now holds more than 75 billion USD in assets. The Gain Bank has since then stolen its competitor's playbook by courting more international investors and raising its foreign ownership cap to 40%. Although the UAE has one of the most diversified economies in the region, it remains extremely reliant on oil, with the exception of Dubai. The UAE is the world's 8th largest oil producer, pumping 3.1 million barrels per day, with oil exporting accounting for about 30% of GDP. The IMF has estimated that UAE needs $69.1 per barrel to balance its books. The fourth one on this list is Kuwait. Kuwait Finance House has postponed its planned merger with Bahrain's Ahli United Bank until December. Kuwait Finance House, that is called KFH, has received a letter from the Central Bank of Kuwait to renew the transaction due to the coronavirus. The merger would have marked one of the region's rare cross-border banking tie-up and credited a combined entity with assets of 104 billion US dollar. Kuwait is an OPEC member and the world's ninth largest oil producer at 2.9 million barrels per day. Kuwait physical break-even of 61.1 US dollars per barrel. The IMF means the country is one of the most adversely affected by oil price crash, though it still has ample backup in its General Reserve Fund. The fifth one on this list is Oman. The Oman Arab Bank has finalized a plan to acquire local competitor Alice Islamic after Omnivest, one of Oman's largest investment funds, sold its 12% stake. The combined entity will become a wholly owned unit of Oman Arab Bank with assets of 4.8 billion US dollars. Oman pumps a million barrels of crude oil per day, making it the world's 19th largest producer, just ahead of Libya. Like most Middle East countries, Oman is heavily dependent on oil and gas resources for 68% of GDP and 85% of government revenue. The country is expected to record one of the biggest budget deficits in the current financial year at nearly 20% of GDP. These are some shocking figures that's coming from Middle East.